Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate with your host, Kevin Perenio. As an owner and C-level executive for 20 plus years in finance, KP is here to serve you with all of his knowledge and experience. Whether you're a broker, realtor, or just interested in the economy, this is the podcast for you. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Newport Beach. Well, I had one last night here before the summer winds down, and we have Labor Day weekend at Newport Beach. I'm getting my 9:30 espresso to kickstart the next 3-hour shift, and then the next after that 17-hour workday. I apologize for not getting my Monday video out. By the way, there's only one ship out there. For those who have been watching this content, we've done a couple segments from the beach, and we used all the cargo ships that lined all the way up, way down past the pier. They even made their way down to San Clemente, which is quite south of here, at one point when we had the supply chain issue, but we don't seem to have that anymore. So let's talk about the economy. Let's talk about what a Fed pivot looks like. And we have a huge jobs report coming out Friday, the August jobs report that comes out, even though it's only the second half of July and the first half of August job data, because it's just hard simply to collect the information. Hope you enjoy the scenery here. Might be the last time for a while, at least certainly in the warm weather. So we have Labor Day coming up this weekend in a few days. So relax, chill. Let's get our houses closed and sold and put our bars in the new home so they can get a barbecue in the new house. Okay, so PCE is a number that the Fed looks at to measure inflation. And Jerome Powell spoke last Friday in Jackson Hole, which is a meeting that the Kansas City Fed puts on. It's like a symposium for a bunch of economists around the world, including all the Fed members. Esther George is the Kansas City Fed president, and so she's the hostess. And then Jerome Powell spoke for only 8.5 minutes, but he used the word inflation 40 times. So 40 times he made it clear that they are going to fight inflation, and it is an invisible tax on everybody in America. It does erode our purchasing power, and so we have to make sure that he attacks it, because it could come back. This supply chain out here, with all these goods that were coming over from across the sea, China, wherever, if he pauses or pivots and doesn't keep hammering the Fed funds rate and try to destroy demand, that demand could race right back up. And one of the ways that demand and inflation is going up is through what's called a wage price spiral, which we've talked about a little bit. So there's still about 10 million jobs open. We haven't had mass layoffs. We're going to find out Friday if that rate of change has turned the corner. But jobless claims actually went down last week on Thursday. That's the weekly reading. So the 4-week average is still, there's been a little bit more jobless claims on a 4-week average, which kind of smooths out the weekly numbers. But this Friday is a big number, as was the PCE number last week, which basically strips out food and energy for the cost of all things. Rent equivalent, still very high. It's a big portion of it, and it's expensive to have a roof over your head in America. But we've already seen from what happens with higher mortgage rates that demand destruction is happening in our business. So we are seeing a lot less loans. Some of the economists like MBA and Fannie Mae have ratcheted down their number this year to 2.4 trillion. We were over 4 trillion for 2 years running, and there are 180,000 jobs created in this industry since the pandemic started, and our volume levels are basically at pre-pandemic levels. So we are deleveraging in our industry. We are definitely scaling down, and we're seeing demand being destroyed, which is what the Fed wants to do. Now, I am not a financial advisor. I am not responsible for your losses, only your profits. The stock market rallied for a couple weeks, and some of us think that was a technical bounce off the bottom, the June 13th low, which, by the way, the 10-year was at 348 on June 13th or June 12th. That was the worst mortgage interest rates were year to date and in the cycle. And since then, we had about 60 days of the stock market rallying, and the Fed funds, the 10-year Treasury coming down, touched almost 2.55. So mortgage interest rates came down quite a bit. You saw the average Freddie Mac rate was about 5.75 and got its way down to like 5.15. So bear with me. Let me try and tie this all together. So in the Fed Jackson Hole meeting, which was super important, he crushed the market last week because he kept saying that they are going to, kill inflation. They're going to fight inflation. So this next meeting coming up in about 3 weeks from the Fed Open Market Committee meeting, they're likely going to raise the rate 75 basis points again. Okay, and there was a big debate whether it be 50 or 75. Let me tell you what a Fed pivot looks like, okay? So the Fed pivot, which by the way, our PRMG campaign 2 years ago was Path to Pivot. We're pivoting to more purchase, business, and consumer direct activities. I love the word pivot. It's not just from friends and Ross Geller carrying the couch up the stairs, but the Fed pivot is something everyone's talking about now. And what it looks like, it comes in 3 stages. I saw a pretty awesome video on like Oxford Club where a lady explained the 3 stages of the Fed pivot. And the Fed pivot is, number 1, lower increments. So they've been doing 75. If they start to do a 50, and they start it now, which they just said on Friday, Jerome Powell just said on Friday, they got to fight inflation. Inflation's a big thing. It can rear its ugly head. If they flinch, the pivot has started. If they only go 50 basis points, they've kind of backed themselves in a corner. They have to do 75. And on my last video, I showed you the CME tool, which basically shows the futures of Fed funds rates. And it was like 52%, 75. Now it's a 68% chance or more of a 75 basis point rate hike. So stage 1 of a Fed pivot looks like lower increments. We're probably not going to see that now. Now, the next meeting is just a couple days for the election. So it's in November, I believe. So I think I'll have to look at that calendar. But one of the subscription services I listen to, Louis Navellier, he doesn't think anything's going to be done at the November meeting just because of the election. So I have to kind of look at the time dates there. And then in December, he thinks a lower increment will happen. So a Fed pivot is going to be data-driven and data-dependent. And it will look like 3 stages. Lower increments, then a pause, and then cutting the rates. So we haven't seen phase 1 yet. So we're still very much looking at higher interest rates from the Fed, which quantitative tightening, which is them loosening their shrinking their balance sheet. This is the lifeguard stand in the city of Newport Beach, the lifeguard headquarters. I'll get you an even better view over here. So they're trying to destroy demand, and they're going to keep raising rates, and we're all gonna notice it. And that demand has already been destroyed out there, and so is our housing demand. Now, I don't use the word like destroyed because still, let's say normalized or moderated. Maybe this is what a soft landing looks like. When you moderate demand or normalize demand and get it back to normal levels, maybe that's what this looks like. Now, if there are so many jobs open, and by the way, I read on LinkedIn that people are taking an average of 8.5 weeks to find a new job, which is like a record. Whereas a year ago, it was 14.5 weeks to find a new job. So people are still finding new jobs. I mean, it's still out there. And so if there's labor hoarding going on by employers, or there's still demand for talent and wages continue to rise, which they have been rising, not at the pace of inflation, not at the rate of inflation, but it is causing a wage price spiral, which is what the Fed wants to destroy. So I'll just let you know that if employers freeze hiring and or cut costs or bring costs down, then that will help kill inflation. It doesn't mean we have to have massive job losses and a job loss recession. We just have to have wages come down to help bring inflation down. So I'm going to say one last thing before we get out of here. I'm a big time ROI guy. Time is money. So to me, talking about time is just like talking about money. So the duration of how long it's going to take for these Fed actions to crush demand and they get the economy in a spot where they feel like inflation is under control. Nobody knows. And that uncertainty has unsettled the markets. And now stock markets have been crashing. Hopefully you had your puts on. In terms of time, the cost for us to work to pay for commodities, it's like 75% less. Never has technology been better. So we're in a good spot. Enjoy your Labor Day weekend. Hope this rambling made sense. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.